Okay, we're going to talk about some of the problems in Chapter 17, but before you do that, I want you to draw this on on a piece of paper so you can have it in front of you because I cannot show it all on the screen at the same time. So these are T accounts, so I have my three inventories: raw materials, work in process, finished goods, and cost of goods sold. Three inventories, cost of goods sold is an expense. I also have a T account of manufacturing overhead. So these are my debit and credit sides. So if you, hopefully by now you know your debits and credits, so basically you can leave those off. But notice when I buy raw materials, it goes in with a debit, it goes out with a credit. So I purchase them with a debit, I transfer them to WIP. So this is going straight to there. So this number and that number will be the same thing. When I add them from raw materials to WIP, I add direct labor and I add manufacturing overhead applied. Notice that comes from manufacturing overhead. I transfer out of WIP to finished goods, so to finished goods from WIP. I transfer out of finished goods to cost of goods sold. Okay. In my manufacturing overhead accounts, on my debits are my actual costs, and on my credits are my applied. So it's coming out of here into there. So make sure you know WIP has applied overhead. Okay, so now I'm going to go pause this and go to the actual problems and walk through two problems. Okay, so problem 17-1A, please print these out and work on them on your own and kind of watch the video as you need help. If you're just watching the video to watch me do it, you're really doing yourself no good. You might as well quit doing that and not watch it at all. But the whole purpose of this is for me to help you as you try to do it yourself. So we use a job order costing. And remember, a job order costing are for unique special order items where I need to charge the customer. So we're putting in fence for a specific customer, so he's going to be charged with the fence that he purchases, the direct labor for the time it takes us, and then some overhead allocation for all the tools we're going to use, as well as the depreciation on the truck and the supervisor, etc., etc. Okay, so we have manufacturing overhead is charged to jobs. So notice I'm going to have tons of jobs throughout the year, so I need a method to give each one a portion of my manufacturing overhead. So I have to estimate my manufacturing overhead for the year. So if you recall, it's pretty important that your formula is estimated manufacturing overhead divided by your estimated base. Okay? And so I estimate my manufacturing overhead throughout the entire year because I want all of my jobs throughout the entire year to get charged with the overhead. So for instance, I don't want to do it monthly because electricity bills will vary from month to month. And I basically don't want to think about it. If I have a job, fencing can only be done when the weather is nice. If I only charged it monthly, no one would pay for my February costs. And those that had their fence installed in February, if the weather was nice, their bill would be enormous because of the heating bills. I also get real estate taxes twice a year, and we certainly, if it's June and September that you get your real estate tax bill, we certainly don't want only those who get their fences installed in June and September to get charged real estate. So I estimate it for the entire year, and then I apply it based on some base. The base you have to be told. So sometimes in my car repair shop example, it was based on labor hours, but let's see how they're going to apply it. So charge to individual jobs through a predetermined overhead rate based on direct labor costs. So my base in this case, and I usually do this, direct labor dollars. Not direct labor hours, direct labor dollars. So it's very important to understand what your base is, how you're applying it. And how you apply your base should reflect how your overhead is used. So for instance, if I have a construction company, it makes sense to have direct labor hours or direct labor costs. Direct labor costs would be if you had to have a difficult construction and so you had more skilled craftsmen working on it who had a higher direct labor dollar, then direct labor dollars would be useful because my overhead would reflect the fact that it's a difficult thing, and I have to have unique and special labor costs. Now, if it used direct labor hours, if the overhead was basically standardized and you didn't want the person to be penalized because you had skilled labor, so let's say you still have your truck and your drills and etc., it might be useful to use direct labor hours, but you always have to be told the base and make sure you know the base. Okay, so the following information appears in the work in process. So I have balance of 5,000. So if you really think about this, I started with work in process with a debit balance of 5,000. I added direct materials of 18, direct labor of 12,000, and overhead, notice it's always applied, at 125% of direct labor costs. So basically I had some amount of estimated overhead and I had some amount of base, and let's say this was $125,000, then this would have been $100,000. So it's 125%. So most of the time I would have just done 1.25 for every direct labor dollar, $1.25 for every direct labor dollar. Okay, so notice it's not uncommon to have way more overhead than direct labor costs because my machinery depreciation, etc., is pretty high. So these are my total debits to the account. So the balance in this account was 50,000, and I transferred 44,000 to finished goods. So 44,000 is coming out of there to there, and so I have 6,000 balance. Okay, assuming that the direct labor charged to jobs still in process amounted to 1,600, compute the amount of manufacturing overhead and the amount of direct materials that has been charged to these jobs. Okay. All right, so if my direct labor is 1,600 and my overhead application rate is 125%, then I'm charging manufacturing overhead of 2,000. Okay, so let me pause this for a second. Okay, so basically what I'm trying to do in this one is to figure out what makes up how much direct material, direct labor, and overhead is in this 6,000. So I could put 3 lines here. Got direct material, direct labor, and overhead. Okay, and it says the direct labor is 1,600, and I know that manufacturing overhead is 1.25, so the manufacturing overhead is 2,000. Can't read my writing very good, but the rest of that $6,000 must be direct material. So notice that 1,600, that's a 6. 1,600 plus 2,000 is 3,600. I need to add up to 6,000, so the remaining 3,600 must be direct materials. All right, prepare the journal entries to summarize. So again, I can't show this, but hopefully you've written it on your paper. If you haven't, I'm not really sure why you haven't. So at this point, do it. Okay, and so think about it. The manufacturing costs are charged to production. When I'm charging them to production, this is my production right there, WIP. So I'm going to debit work in process for the total amount. Okay, and I'm going to credit materials inventory, direct labor, and manufacturing overhead. Now, I probably would have looked at this quickly and picked up the 50,000, but notice that there's 5,000 already in it. Okay, so I probably would have rewritten this problem to put beginning inventory plus what's added, direct materials, direct labor, and overhead. Okay, so I credit my materials inventory. It's coming out of my materials inventory to WIP. I'm going to debit raw materials or work in process for that. And then notice manufacturing overhead, when you apply it, is credited and debited work in process. So your journal entries are debit work in process for the total of those 3, credit materials inventory. Credit, I tend to prefer wages payable rather than direct labor, or direct labor payable. I'd prefer you put a payable in there instead of direct labor. And credit manufacturing overhead, because remember, this is applied, and you always credit manufacturing overhead for applied. Okay, so notice no place have they told me in this particular problem how much actual manufacturing overhead costs. We're going to assume they're going to add up to well over $15,000. The transfer the completed production, so it's going out of WIP to finished goods, and it says I did 44,000, so I'm going to credit WIP and debit finished goods. And then I sold 80% of the merchandise. Okay, so remember I've got 44,000 in finished goods, and it's going out of finished goods to cost of goods sold. And so I'm going to take it 80% of that 44,000 out of finished goods and put it into cost of goods sold. But whenever I have a sale, I have two entries, one for the sale price and one to move it out of inventory. So notice I have my income statement of sales of 50 minus cost of goods sold. And my ending inventory for finished goods will be 44,000 I put in there minus the 35,200 I took out. Okay, now let's go on to problem 17.2, and again, have this in front of you because I'm not going to be referring back to it by showing it. But I purchased direct materials during the month of 59.7, debit materials inventory. You can also debit raw materials inventory, credit accounts payable. Okay, next one, I requisition materials for production. Remember, production is WIP, 56.2, so I take it out of materials and put it into WIP. In with a debit, out with a credit. Next one, time cards for direct workers, 2,000 hours worked for a total of 30,000. So I put my direct labor, debit WIP, credit direct labor payable or wages payable. D, direct workers were paid. Okay, so notice if I put wages payable here, I'm going to debit wages payable, credit cash. So it puts it into work in process when they're earned, not when they're paid. So this is just like financial accounting, which would be wages payable cash. Actual. So if I'd scroll back up, I said I wasn't going to do it, but actual is on the debit side. Okay, so I have actual manufacturing overhead of 39.4, and I credit accounts payable, whatever it is. If it's for supervisor salary, it'd be salaries payable. If it's utilities, it'd be utilities payable. But whatever it is as my credit. The debit is no longer an expense because an expense would be a period cost. I debit manufacturing overhead for a product cost. An indirect product cost, to be exact. Okay, overhead is applied to jobs. Go again up here. When I apply it, I debit WIP, credit manufacturing overhead. So I debit work in process, credit manufacturing overhead. At a rate of $18 per direct labor hour. So I take 18 and I'm looking for the direct labor hours, and it says 2,000 hours worked on various jobs. So 18 times 2,000 is 36,000. Next one, jobs were finished. So I take them out of WIP and put them into finished goods, and then I sold some. So remember, there's always two entries when you make a sale: accounts receivable sales for the selling price and cost of goods sold finished goods inventory for how much they cost us. I could also in this problem do my balances and inventory just by making T accounts of materials inventory. Here's how much I put in, there's how much I took out. So it looks like I've got about 3,500 in there. I could do the same with WIP. Here I added materials, added labor, added overhead, and here's how much I took out. So these would be on my debits, this is my credit, my balance is ending inventory. And my finished goods, here's how much I put in, here's how much I took out. So that's my balance and inventory. So that's a walkthrough of chapter 17. Make sure you practice these. I found more people have difficulty with 17 because 18 is so difficult that they don't spend a whole lot of time on 17. So give it a shot.